Welcome to the Big Money Show. I'm Dagan McDowell, and a big welcome back to Taylor Riggs.
Thanks, everyone. Love you all.
And also here, my co-hosts, David Asman, Jackie DeAngelis, and with us for this hour, Great Hill Capital Chairman Thomas Hayes.
I think we need certainty in either direction. So I think actually, regardless of how it turns out in the short term, markets can breathe a sigh of relief, as they have been. They've been breathing through this whole thing, and at least getting big clarity on this big issue.
Yeah, I agree with you, Taylor. The big thing, though, this is all about the bond market. If we had to hypothetically return $215 billion of revenue, you're going to see yields spike. Part of this is, we ran a surplus, $31 billion collected. We ran a $256 billion surplus. In April, that was related to tax also, in addition to the tariffs. September, we ran a surplus. So it's showing fiscal responsibility. And we as taxpayers, inflation has been modest. We're getting defense, we're getting infrastructure, we're getting education, we're getting all these things without additional taxes. So, and that's evidenced by the fact that inflation has been subdued. If this was explicitly a tax on the taxpayer, inflation would probably be running 4%, 5%, et cetera. Plus the compression of the bond yields, because we're getting this additional revenue showing responsibility, has brought down financing costs. And we're on the cusp, potentially before the end of the year, of a 30-year fixed rate mortgage below 6%. I think we're at 6.15 today. And a lot of this is a function of record revenue starting to pour into the Treasury, both from growth for deregulatory growth policies and from tariff income.
Say that's the case. We talked about the Supreme Court ruling on tariffs and how it could potentially impact markets. This is the financial capital of the world.
Yeah.
How does that impact markets if indeed this is what we see? I said earlier, New York will survive and we'll get through it. Somehow we always do.
Yeah.
But is the stock market going to feel that way?
Well, 20 years ago, the centers of the financial world were New York and London. The trend has moved toward, seriously, Florida and Dubai. Money goes where it's treated best. And if Mamdani was elected, I think you're going to see that trend exacerbated. You're going to see more jobs in Dallas. You're going to see more jobs in Miami. You're going to see more money flow to Dubai. But the sad thing is the poll, the NBC poll, 44% of Americans are positive on capitalism, only 25% of Democrats, and 35% of Democrats are positive on socialism. So on the one hand, if he gets elected, maybe you'll have a case study of why not to do it, and people will wake up, because we saw it in the 70s, what happened in New York. We saw it with Dinkins in the 90s, and maybe people need to see the results before they can change their mind.
80s Dinkins. 90s was Giuliani.
Yeah, 90s he came to speak to Columbia, and I fell asleep during the lecture. But this is not a positive trend. As it relates to the stock market, I think it'll be a blip. I think the decision on tariffs is going to be the critical decision this week with regard to the bond market. And as Dagan said before about interest payments too, remember, Powell has been 150 basis points too restrictive. So as that continues to come down, our interest servicing on the short end is going to come down. They've been refinancing a lot on the short end of the curve, but the fiscal responsibility on the long end of the curve is what we want, and we're getting that from tariffs, and we're getting that from record taxes due to growth and deregulatory policies. Atlanta GDP now, estimates for this quarter is 3.9% GDP growth. That brings in a lot of tax revenue because people are making money.
You bring up a good point.
So the question is, has Warren Buffett changed, or has Wall Street? Tom, I want to come to you on this, because growing up, truly it was the Oracle of Omaha. You would read those shareholder letters. You would try to get a seat in that building, right, just to try to hear anything he would say.
Yeah.
Because we've pivoted to this world that appears to be going to AI.
Yep.
Is that company just not able to keep up with the times, or should I not bet against Warren Buffett?
You never want to bet against Warren Buffett. This reminds me of the year 2000. They had all the covers. Has Warren Buffett lost his touch? When you had the tech boom and he was buying Coca-Cola and Procter & Gamble, you couldn't give away those stocks. And over the next 4 years, as the NASDAQ fell 80%, Warren Buffett dramatically outperformed. He had some of his best 4 years in history while everyone else was losing their shirts. I would say two things. Number one, he's built up $380 billion of cash. I think there's an element he wants to go out like Simon Seinfeld at the top. And he is the greatest of all time since inception. He's compounded money at just under 20% per year relative to the S&P at 10%. And what does that mean in English? 5.5 million% return versus 39,000% return for the S&P 500. So never bet against Warren Buffett. However, I don't think the premium will be justified moving forward. What's going to happen for the next year is he'll step away. There will be pressure after he's gone to break up the company for the sum of the parts are greater than the whole. Yep. Most conglomerates trade at a discount. Buffett's trades at a premium. The culture will be his son will hold the culture in place for 2 years, and eventually the pressure will grow. So I think short term, when he's no longer involved, there might be a headwind on it. I think long term, they will start to pound the table for dividends. They will start to pound the table for breakups. And when people do the sum of the parts, they'll say this is pretty valuable, and maybe you get a little of that premium back.
You know, Dave,
that's what I love about it. There's some things that AI simply cannot do, and Warren Buffett is an example of that.
Yeah, in English, all that means for the layperson is if you put your money in the S&P, it doubled every 7.5 years. If you put your money with Warren Buffett, it doubled every 3.5 years. That's a big deal. And you know the penny thing in the lake, it compounds very, very quickly.
If you put your money in Palantir this year,
yes,
you more than doubled your money. You guys, this is a stock. It's up 165% this year alone. It's up an additional I remember this was like an $11 stock, right? It is a $205 stock. It's incredible. They're reporting earnings after the bell today. Tom, quick thoughts. They're looking at what could be $1 billion in revenue. People have said, look, valuation is a concern. I was looking by some measures. You're looking at 200, 400 times PE. Mind-blowing numbers. Wedbush, though, upgrades this to a $230 stock, saying this is a $1 trillion business. Your thoughts?
I don't know. $1 billion times 4 is $4 billion. Is that worth $1 trillion? That's top line, not even profits. So is it worth 250 times sales? Right now, the market says it is, but here's the thing about these situations. This can go on a long time. It can be worth $2 trillion. But at the end of the day, the value of a stock is the sum of the future cash flows discounted back to today. So if I'm paying 200 times sales and they miss by 1%, the stock is not going to go down 1%. The stock's going to go down 50%. So rule number one of Warren Buffett was don't lose money. Rule number two is don't forget rule number one. When you're buying a stock that's trading at 100 or 200 times sales, you are taking a gamble that can continue for a long time.
But how do you bet against
when the tide goes out, you see who's swimming naked. So I would just say if you want to be in this and ride the momentum, size it proportionate to the amount of risk. It can keep going, but when it stops and the music is over, you better find a chair.
The AI infrastructure build-out is moving quickly, and NVIDIA is selling shovels in the gold rush. Remember that expression, which I love, one of my favorites, Thomas. But it's now up right now about almost 4%, 3.75%. Are you buying?
I'm not a buyer at these levels. I will say, listen, one of the best performing AI stocks of the year is Intel. And the reason is NVIDIA relies on the kindness of strangers. NVIDIA is a chip designer, one of the best in the world, obviously, or the best in the world. I like the fact that they're selling to UAE. I want them to sell to more countries. I was a little hesitant with the withhold from China. I understand the national security, because we want to keep all these countries dependent on a U.S. producer, not independent. If we don't give it to them, what do they have to do? Well, they have to create it on their own. They have to. China
doesn't have to create it on their own. They steal what we have. That's why we're trying to keep it away from them. But you think there's a symmetry between Intel and NVIDIA that's perfect. NVIDIA designs and Intel makes.
That's correct, because they were fully dependent on the kindness of strangers with Taiwan Semiconductor. They were limited to $4 billion revenue growth per quarter. So they weren't slowed up by demand. They were slowed up by supply. Intel is now going to start to fill some of that supply. So the best thing that can happen to NVIDIA is that Intel continues to succeed. And the taxpayer is going to make a tremendous amount of money on this investment. They're already up over double. And they're probably going to be a 5-bagger over the next 3 to 5 years, which is going to be more
And do you
than
hold
NVIDIA.
Intel?
We do own Intel.
Okay. All right. I figured that.
I would
Taylor,
hope so.
There's a drill down. Terrific stuff, everybody. Thank you. Thomas, thank you. Good having you here for
Thanks for having me.
Appreciate it, Thomas Hayes.